At exactly 10 a.m., the global crypto market cap is holding steady. Traders are calmly sipping their coffee. Algorithms hum quietly in the background. Everything appears normal. By 10:30 a.m., $40 billion is gone, completely vaporized. In just 30 minutes, that amount exceeds the GDP of entire nations. It disappeared before most traders even had the chance to refresh their screens. Normally, when money burns this quickly, there is a visible cause. When FTX collapsed, we understood why. When Luna fell to zero, we watched the algorithm fail in real time. When an exchange is hacked, the stolen funds can be traced across the blockchain. But on February 10th, there was only silence. No breaking headlines. No CEO in handcuffs somewhere in the Bahamas. No exploited code. No sudden government ban. The news feeds were empty, yet $40 billion had been erased from the ledger. This was not a robbery. It was not a hack. It was something far more unsettling. It was a ghost crash, a distortion in the very fabric of market reality. And the most frightening detail is not that it happened, but that for the first several hours, no one could explain why. If you are holding crypto, stocks, or any financial asset right now, you need to understand what unfolded during that 30-minute window. Because it didn't just shatter the charts, it exposed a structural weakness in the financial plumbing that still exists today. This is the story of the silent crash. To understand how the floor suddenly disappeared beneath the global market, we must examine the days that led up to it. The market did not simply wake up and decide to collapse on February 10th. It was already ill. In truth, it had been weakening for months. Rewind 3 days, February 7th, 2026, the Bitham incident. This was the first tremor. An operational error occurred at Bitham, a major exchange. It wasn't a hack, it was a mistake. A classic fat finger error. Someone or something accidentally transferred an enormous quantity of Bitcoin. $40 billion worth of Bitcoin was sent out by accident, a clerical catastrophe. Yes, the issue was corrected. The funds were recovered. The chaos passed quickly, but the psychological damage remained. Picture yourself walking across a frozen lake. You believe the ice is solid beneath your feet. Then suddenly, a loud crack echoes through the air. The ice holds, but you stop moving. You freeze in place, terrified. That is what the Bitham error did to the market. It didn't break the ice, but it warned every major investor that the surface was dangerously thin. Nerves were shattered, traders became skittish, fingers hovered above the sell button, waiting for the next sound. And they had every reason to feel afraid. Zoom out and study the broader picture. October 2025 marked the peak. Bitcoin surged to $126,000. Everyone felt like a genius. Everyone felt wealthy. The total market value surpassed $4 trillion. Fast forward to February 2026. $2 trillion had vanished. 2 trillion. That is not a sudden collapse. It is a slow, agonizing bleed. For 4 consecutive months, the market had been grinding lower. Prices slipped. Hope faded. The market was no fortress. It was a parched forest. Rain had not fallen in months. The wood had turned brittle. The ground was scorched. It didn't require a flamethrower to ignite. It only needed a spark. A small, almost insignificant spark. Which brings us to the morning of February 10th. The bulls, those betting on rising prices, were desperate. They were calling the bottom, insisting, "This is it. Prices are cheap. Time to buy." They were wrong. Institutions, the big banks, the hedge funds were not accumulating. They were leaving, quietly slipping out the back door. This created a dangerous condition known as thin liquidity. Visualize a safety net. Under normal conditions, when people sell, buyers wait below, ready to catch the price. If I sell Bitcoin at $90,000, someone buys at $89,900. The price moves slightly, but the system holds. Yet fear, the Bitham error, and the 4-month decline had driven the buyers away. The safety net had been cut. So when selling began at 10:08 a.m., nobody was there. Only a void remained. Thousands were trying to escape through a door that had been welded shut. This set the stage for the most dangerous mechanism in modern finance. It isn't fear. It isn't greed. It is the leverage cascade. When the price dipped just 1%, it should have been an ordinary Tuesday. But in a market this fragile, even 1% was too much. The robots took control. Automated trading systems detected the drop and triggered stop-loss orders, automatic sales designed to prevent deeper losses. But remember the thin liquidity. Remember the missing safety net. When the robots sold, there were no human buyers waiting, so the price fell another 1%. That activated the next wave of algorithms. They sold. The price plunged harder. A perfect domino chain, a self-fulfilling prophecy of destruction. Bitcoin fell 2%, then 3%. Altcoins such as Solana and Ethereum collapsed even faster. Within 30 minutes, $1.5 billion in futures positions were liquidated. Traders who had borrowed money to bet on rising prices were forcibly closed out by exchanges. They had no choice. The system sold their assets to cover the debt. Selling breeds more selling. Panic multiplies panic. By 10:30 a.m., the smoke cleared. $40 billion in wealth had been erased, and the most disturbing detail? The systems functioned exactly as designed. There was no coding glitch. The flaw was embedded within the market structure itself. Buyers had gone on strike, and sellers had nowhere left to go but down. This wasn't merely a bad day, it was a repricing of risk. The market looked at the world, examined the economy, and concluded that crypto had become too dangerous to hold. But why now? And more importantly, is this the bottom? Or is it the opening of a trapdoor leading much lower? To answer that, we must examine who was truly selling. It wasn't retail traders tapping on their phones, it was the whales. And whales tend to know something before everyone else does. To understand their exit, you must look beyond crypto charts and focus on money itself. The whales left because the cost of money changed. For years, crypto thrived on cheap capital. When interest rates are low, holding cash feels pointless. You want assets, Bitcoin, Ethereum, Solana. You embrace risk because banks pay you almost nothing to save. But in early 2026, the board flipped. The macro environment turned hostile. The Federal Reserve signaled that rates would not fall as quickly as markets had hoped. This is financial gravity. When rates remain elevated, the dollar strengthens. When the dollar strengthens, risk assets suffer. The whales saw it coming. They didn't sell out of hatred for Bitcoin. They sold because the math no longer worked. Why risk losing 20% in a volatile market when you can secure a guaranteed return in risk-free bonds? This sparked the stablecoin exodus, a metric most retail traders overlook, yet it is the market's heartbeat. Think of stablecoins like USDT or USDC as poker chips on a casino floor. Even if you aren't actively playing, as long as your money is in chips, you remain inside the casino ready for the next hand. But throughout January and early February, the supply of those chips began shrinking. Investors weren't just converting Bitcoin into stablecoins. They were redeeming stablecoins for actual US dollars and wiring the cash back to their bank accounts. They weren't stepping away from the table. They were leaving the casino entirely. That removed the dry powder, the sidelined cash waiting to buy the dip. When the crash began on February 10th, social media echoed with cries of "buy the dip." But there was no dry powder left. The money had already exited the building. This explains the violence of the drop. In a healthy market, a $100 million sell order is absorbed by thousands of smaller buyers. The needle barely moves. But on February 10th, market depth was paper thin. Market depth is like water in a pool. If the pool is deep, a cannonball causes only a ripple. If the pool is shallow, if liquidity is thin, that same cannonball sends water exploding outward. You slam into concrete. That sell-off was a cannonball into a kiddie pool. When Bitcoin slipped just 2%, it dragged the entire ecosystem with it. Ethereum, XRP, and BNB tumbled 3% to 4% almost instantly. It sounds minor. 3% is routine in crypto. But remember the leverage. The 2026 crypto market was heavily leveraged. Traders borrowed 10x, 20x, sometimes even 50x their capital, betting on a rebound that never arrived. When prices dipped 3%, those loans turned toxic. Exchanges issued margin calls, add more funds, or we close your position. No one had additional funds. The dry powder was gone, so the exchanges sold. This created a feedback loop from hell. The exchange sells to cover debt. The price drops. Another trader's debt triggers. More forced selling follows. Round and round it goes. In total, over $1 billion in trading positions were liquidated around this event. That is not just a number on a screen. That represents real collateral, real savings, real homes, real paychecks, transferred from the impatient to the prepared. It wiped out the optimists. It erased those convinced the floor had already been set. And it marked a massive psychological shift. For 5 years, the winning strategy had been simple: buy the dip. Every crash eventually made buyers rich. Months later, it became Pavlovian. Crash equals profit. February 10th shattered that belief. Investors realized that buying dips in a high-interest, low-liquidity world isn't investing. It is catching a falling knife. Psychology pivoted from greed to preservation. No one wanted to be a hero anymore. They just wanted to survive. That is why the recovery looked so weak. Yes, Bitcoin bounced slightly after the 30-minute inferno. Dead cat bounces appeared, but the trend was broken. Analysts who had recently predicted $100,000 abruptly changed their tone. Targets shifted downward, $38,000, then $40,000. The $2 trillion erased since the October peak was no simple correction. It was a repricing. The market was searching for a new bottom, and it had not found one yet, which leads to the most dangerous realization of all. If crypto is falling because of liquidity and interest rates, what happens when those same forces reach the stock market? Crypto is the canary in the coal mine, the first asset to die when liquidity dries up, but rarely the last. The $40 billion glitch was not isolated. It was a warning shot aimed at the global economy. Liquidity is shifting, and to see where it may strike next, you must examine the charts many are afraid to show. Around 11 a.m., the smoke seemed to clear. Green candles appeared. Bitcoin ticked upward. Ethereum stopped bleeding. To an untrained eye, it looked like recovery, as if the market had absorbed a brutal punch and staggered back to its feet. Social media traders celebrated, posting screenshots of buy orders, claiming they had captured the bottom. They hadn't. They had grabbed a falling knife that merely paused midair. This is the most dangerous phase of any crash, the dead cat bounce. The logic is grim. Even a dead cat will bounce if dropped from high enough. The slight recovery wasn't fueled by new capital or renewed confidence. Sellers were simply taking a lunch break. Short sellers were locking in profits. Once they stepped away, the buying pressure vanished again. And this reveals the harsh truth about the crypto market in 2026. The trend is your friend until it betrays you. And right now, the trend is not upward. Since the October 2025 peak, the market hasn't merely stumbled, it has been decimated, from over $4 trillion to barely clinging to 2. Half the industry's money is gone. The February 10th event wasn't random. It was a symptom of a deeper illness, the market signaling that prices remain too high. Even after losing $2 trillion, crypto may still be overpriced. That is why experts are not celebrating the bounce. They are studying the floor. Before the crash, analysts defended $45,000 as Bitcoin's unbreakable fortress. The fortress fell. Now the same analysts aim lower, $38,000 to $40,000. If Bitcoin drops to $38,000, everything else is pulled toward the abyss. That number represents psychological surrender. Break it, and the buy the dip crowd becomes extinct. The game changes. Last cycle demanded aggression, chasing volatile coins for rapid gains. But in a market capable of deleting $40 billion in half an hour without a single headline, aggression is lethal. The new objective is survival. This wipeout proved that even blue chips, Bitcoin and Ethereum, are not safe havens. They fell instantly. Altcoins were annihilated, some plunging 10% to 15% in moments. This is the flight to safety. When a building burns, no one pauses to collect fine china. They grab cash and run. In crypto, Bitcoin is the cash. Everything else is the china. And on February 10th, a lot of china shattered. So where does that leave us? A market without liquidity. Whales fleeing toward the US dollar, charts pointing to $38,000. Millions of retail investors utterly exhausted. They held through the October decline, through the Bitham error, through the February wipeout. But everyone has a breaking point. Markets are designed to locate it, grinding lower until the final hopeful holder sells in disgust. That is usually the bottom. We are not there yet. The frightening part isn't price volatility, it is correlation. For years, crypto believers insisted Bitcoin was uncorrelated, moving independently from traditional markets. That was a myth. February 10th exposed the truth. Crypto is a high-speed mirror of the global economy. When fear spreads, crypto falls first. It is the early warning system. And right now, that system is flashing red. Because if $40 billion can vanish due to macro fears and interest rates, what happens when those same fears strike a market 100 times larger? What happens when the liquidity void opens beneath the S&P 500? The data is already whispering the answer. The stock market is flashing the same signal crypto showed days earlier. If you believe your portfolio is safe because you don't own Bitcoin, think again. Contagion is approaching. Here is the most uncomfortable truth. Crypto is the last true free market on Earth. It trades nonstop, 24 hours a day, 7 days a week. No closing bells, no circuit breakers, no pauses when conditions turn ugly. Because of this, crypto is the exposed nerve of the global financial system. It feels the pain first. When global liquidity begins to evaporate, the stock market doesn't immediately reflect it. Stocks are buffered by structure and regulation. Crypto has no such protection. So when $40 billion disappears on an ordinary Tuesday morning, it isn't merely a crypto problem. It is a global liquidity signal, smoke before the fire. Consider who trades these markets now. In 2017, it was mostly retail investors in basements. By 2026, it is hedge funds, family offices, and high-frequency algorithms, the same forces driving Wall Street. The money is interconnected. When a hedge fund is liquidated in Bitcoin, it bleeds. A hole opens in its balance sheet. Cash is needed immediately. Where does that cash come from? They sell their winners. Apple, Nvidia, the S&P 500. This is how contagion spreads. The February crash was a liquidity crisis driven by absent buyers. Now examine equities. The S&P 500 has been running on the same thin liquidity that broke Bitcoin. Volume is low. Buyers are fatigued. And like crypto, stocks are addicted to leverage. Crypto relies on futures. Equities lean on zero-day to expiration options, bets that expire within 24 hours, pure speculation. The same mechanism behind the leverage cascade. Trillions ride on these short-term wagers. If markets drop 1%, algorithms panic. Selling accelerates. Options trigger further liquidation. Sound familiar? It should. It is the identical script behind the $40 billion wipeout. The plumbing matches. The risks match. Only the scale differs. Crypto is a $2 trillion asset class. The U.S. stock market approaches $50 trillion. When crypto sneezes, billions vanish. If equities catch the same cold, retirement accounts evaporate. Pensions disappear. Governments tremble. So what should you do? Stop thinking like a gambler. Start thinking like a survivor. Buying dips works in bull markets fueled by cheap money, but the printers are silent. Rates are high. Liquidity is scarce. In this environment, cash is a position. For years, people mocked cash, warning inflation would erode it. Yet today, cash is one of the few assets that cannot crash, 40% in 30 minutes. Cash is optionality. Cash is patience. Those who survived February 10th were the ones sitting on their hands, not chasing falling knives, but waiting for them to strike the floor. They are waiting for the flush, the final stage of a crash, when everyone gives up and prices become undeniably attractive. We are not there yet. Analysts calling for $38,000 Bitcoin may actually be optimistic. If equities follow crypto into the liquidity void, $38,000 could look like a ceiling rather than a floor. We may witness prices that rewrite financial history. This is not about being bearish or bullish, it is about staying awake. The market has changed. The rules of 2024 and 2025 no longer apply to 2026. The algorithm has shifted from growth at all costs to the return of capital. Protect what you have. Understand that 30 minutes can erase months of gains if you are over-leveraged. The Bitham error was the warning. The February 10th crash was the lesson, but the final exam is still ahead. And the frightening part is not that markets are falling. It is that the charts are aligning perfectly for another leg down. Most people stare at Bitcoin candles hoping for green. They are watching the wrong signal. There is a specific indicator, a liquidity heat map, that predicted the February 10th crash 3 days in advance. It revealed the void, the air pocket where buyers once stood. And right now, that same heat map is flashing red for the Nasdaq. Liquidity has drained from the tech sector. Buyers have pulled their bids. The safety net is gone. You need to see this chart. You need to understand where the void lies so you don't step directly into it. Watch the video right here. It reveals the liquidity heat map for the S&P 500 and pinpoints the exact day next week when algorithms are signaling the next flash crash. Don't wait.